All right, let's put this puzzle together, okay? We talked about three financial statements, and all three of them are linked to each other, okay? We've got the balance sheet, which tells you what do you own. You've got the income statement, which tells you how much do you make. And then you've got the cash flow telling you, well, hold on a second. What you told me I make is not cash. And here's how we reconcile that, okay? Cool. Now, all these statements are related. And if you understand the relationship between the three financial statements, you can test to see if you made mistakes, okay? And so the relationships are as follows. So we've got the balance sheet there, and that basically has retained earnings, and that is connected to the bottom of the income statement, okay? Think about the wording too, retained earnings. What does that mean? It's earnings we've retained. And so if you look at the difference between retained earnings on the balance sheet between 1 year and the previous year, it's the exact same thing as net income from the income statement, okay? So that's your check and balance right there. That's your link between the two statements. And I know there's an exception if you have dividends, it's a little bit different. We're not going there. All right, let's talk about the next relationship. The next relationship is between the cash flow statement and the income statement. Okay, so remember with the cash flow statement, you start with net income, then you add back all that stuff. Okay, and so net income from the bottom of the income statement is connected to net income at the top of the cash flow statement, right? All right, and we also have the change in cash flow, right? At the bottom of that cash flow statement, right? The change in cash flow from 1 year to the next should be equal to the change in cash flow from 1 year to the next, or change in cash, I should say, from 1 year to the next on the balance sheet there. Okay, cool. Now we understand the relationship between all three of these financial statements, right? So what can we do now? Well, this is where it gets really cool. Now we can forecast the future by making financial models. And once we've done that, once we've mastered the financial model process, then we can pick target prices, meaning what our companies we are looking at should be worth.